Okay, so you've requested a deep dive into something that's been making headlines and impacting wallets everywhere, inflation and deflation. And you're not just here for buzzwords, right? You want to understand the forces at play, how are they measured, and what they might mean for your life. Well, strap in, because we're about to unpack all of that using this insightful article from ClearTax. Let's start with a scenario I'm betting we're all familiar with. Imagine strolling into your favorite cafe, ready for your daily caffeine fix, only to find that your usual latte just got hit with a price hike.
Frustrating, isn't it?
Well, that, my friend, is inflation in action.
Precisely. It's the phenomenon of rising prices across the board, not just for your morning coffee. And it's not just about noticing a difference here or there. Economists actually measure this using specific indicators like the Consumer Price Index or CPI.
Okay, time to tap into your expertise here, because I'll confess, economic indicators aren't exactly my go-to conversation starters. What exactly is CPI, and how does it reflect inflation?
Great question. Think of CPI as a representative basket of goods and services that everyday consumers purchase, things like food, housing, transportation, and yes, even that latte. The CPI tracks how the prices of these items change over time. If the cost of that basket goes up, it signals inflation.
So it's like taking the pulse of an economy by looking at the prices of those everyday essentials. That makes a lot of sense. The ClearTax article uses this interesting example of apples to illustrate this, right?
Yes. It points out that if a kilogram of apples cost, say, $10 last year, and now the same amount costs $11, that's a 10% jump in price, a clear indicator of inflation. And when these kinds of price increases become widespread across different sectors, that's when economists really start to pay attention.
So we've established that inflation is about rising prices, and it's measured by tracking the cost of goods and services over time. But here's where it gets really interesting. The ClearTax article mentions that a healthy rate of inflation actually exists. Now, that sounds counterintuitive. Why wouldn't we want prices to stay put or even go down?
It's a common misconception that any inflation is a bad thing. In reality, a small amount of inflation, around 2–3%, is generally considered healthy for a growing economy.
Okay, I did not know that.
Yeah.
Why is that the case?
Think of it this way. A little inflation usually indicates that people are confident about the economy. They're spending money, businesses are investing, and wages are rising. It's a sign of a dynamic and expanding economic landscape.
So a bit of inflation is like a pulse, a sign that the economy is alive and kicking. But the ClearTax article also delves into what happens when inflation gets out of control, right?
Right.
What are some of the culprits behind those price surges that send economists scrambling?
The article highlights several key factors. One significant driver is the money supply, essentially the amount of money circulating within an economy.
Right, because if there's more money sloshing around, wouldn't that lead to a decrease in its value, making things more expensive?
Exactly. It's a matter of supply and demand. When the supply of money outpaces the supply of goods and services, prices tend to rise. This can happen for various reasons, such as government spending or changes in central bank policies.
The article also connected national debt to inflation. And I'll admit that one always makes my head spin a bit. Can you help untangle that connection for me?
Absolutely. When a country accumulates a large national debt, it often needs to borrow more money to cover its expenses. This can increase the money supply, potentially leading to inflation if not managed carefully.
So it's a bit like a domino effect. Excessive borrowing can fuel inflation. The ClearTax article goes on to discuss demand pull and cost push inflation, which sound intriguing, but also a tad technical. Can you break those down for us?
Of course. Imagine a wildly popular product hitting the market, a new gadget, a limited edition sneaker, you name it. Everyone wants it, demand skyrockets, but the supply can't keep up. What happens? Prices surge. That's demand pull inflation in action.
So it's like those concert tickets that sell out in minutes, and then you see them being resold online for triple the price. Makes sense. What about cost push inflation?
Cost push inflation occurs when the cost of producing goods or services increases, forcing businesses to raise prices to maintain their profit margins. Think back to those supply chain disruptions we experienced recently. Remember the global chip shortage that impacted everything from cars to electronics?
Oh, I vividly remember those days. It felt like everything was either out of stock or significantly more expensive.
Exactly. Those shortages drove up the cost of components, which then rippled through various industries, ultimately leading to higher prices for consumers. That's a classic example of cost-push inflation in action.
So whether it's soaring demand for a hot new item or rising production costs due to external factors, these forces can push prices upward, leading to inflation. Fascinating. Now let's flip the script and talk about the often misunderstood cousin of inflation, deflation. Is it simply the opposite, where prices go down and everyone rejoices, or is there more to this story?
Deflation is a tricky beast. While cheaper goods and services might sound appealing on the surface, persistent deflation can actually be a warning sign for an economy.
Really? That's surprising. Why is that the case? Wouldn't lower prices be a good thing for consumers?
While it might seem counterintuitive, deflation can lead to a vicious cycle. When prices are consistently falling, people might postpone purchases, expecting even lower prices in the future. This can cause a decrease in consumer spending, which is a major driver of economic growth.
So it's like a deflationary spiral. Falling prices lead to delayed spending, which further depresses prices. It's a bit like that feeling when you see a fantastic sale, but then you wonder if it's too good to be true and if there's something wrong with the product.
That's a great analogy. The ClearTax article highlights a couple of significant contributors to deflation. One is increased competition, which can be a double-edged sword.
Right, because on the one hand, more competition usually benefits consumers by offering more choices and potentially lower prices. But I can see how it could become problematic if it gets too intense.
Precisely. While healthy competition is generally a positive force in a market economy, excessive competition can lead to a race to the bottom on prices.
So instead of innovating and improving products or services, companies become fixated on undercutting each other, which could hurt their long-term prospects and potentially lead to deflation if prices are pushed down too far.
Exactly. The ClearTax article also points to technological advancements as another potential driver of deflation.
Now, that's an interesting one because technological progress is generally seen as a positive thing, right? I mean, think about how much more affordable and powerful our devices are today compared to just a decade ago.
Absolutely. Technological innovation is a crucial engine of economic growth, but it can also contribute to deflation in certain scenarios.
Yeah.
Think about it. When technological advancements lead to significant increases in productivity, companies can produce more goods or offer more services with fewer resources.
So while that's fantastic for efficiency and potentially lower prices in the short term, it could also lead to deflation if those price reductions happen too rapidly or become too widespread.
Exactly. It's all about finding a balance. Now, let's shift gears and bring all of this back to you, the listener, because understanding inflation and deflation isn't just about acing your economics exams. It's about equipping yourself to make informed financial decisions in the real world.
Absolutely. We're not here to just drop some economic theory and leave you hanging. We want to help you connect these concepts to your own life and finances. So how can understanding inflation and deflation translate into practical advice for managing our money?
One of the most critical takeaways from the ClearTax article, in my opinion, is the importance of considering inflation when it comes to long-term savings, particularly for retirement.
Because even a seemingly small percentage of inflation each year can significantly erode the purchasing power of your savings over time, right?
Precisely. For instance, let's say your goal is to have a certain amount saved by the time you retire. You can't just assume that that same amount of money will have the same buying power in 20 or 30 years.
That makes a lot of sense. So how do we combat this invisible force of inflation eating away at our hard-earned savings?
The key is to invest your savings in a way that outpaces inflation. This is where diversifying your portfolio comes into play, as the ClearTax article suggests.
Okay, so diversification. It's a term we hear a lot in the finance world. But for those of us who might not be investment gurus, can you break down what it means and why it's so important in the context of inflation?
Absolutely. Diversification is essentially a risk management strategy. It's the idea of not putting all your eggs in one basket, so to speak. Instead of investing all your money in a single asset class like stocks or bonds, you spread your investments across different asset classes.
So a mix of stocks, bonds, real estate, maybe even some commodities or alternative investments, depending on your risk tolerance and financial goals.
Exactly. The logic is that different asset classes tend to perform differently under various economic conditions. So, if one investment isn't doing so hot, you have others to cushion the blow, potentially mitigating losses and hopefully staying on track to reach your financial goals.
It's like the old saying, don't bet the farm on one horse. Or in this case, don't bet your entire retirement on one investment. Makes perfect sense.
And speaking of managing risk and keeping our economic ship afloat, the ClearTax article mentioned the Reserve Bank of India's role in all of this. It made me realize that there are institutions actively trying to steer the course when it comes to inflation and deflation.
Absolutely. The RBI is like the central bank of India, and one of their primary responsibilities is maintaining price stability within the country. They're like conductors trying to orchestrate a harmonious balance in the economy. Okay, I love that analogy. So how do they actually attempt to control these economic forces? What tools do they have at their disposal?
Well, one of their most powerful tools is adjusting interest rates.
You mean like the interest rates we pay on loans or earn on savings accounts? How do those tie into the bigger picture?
Those are definitely part of it. By raising or lowering those key interest rates, the RBI can influence how much money people are borrowing and spending. If inflation is heating up, they might raise rates to cool things down a bit, encouraging saving over spending. If they're worried about a slowing economy and the threat of deflation, they might lower rates to try to stimulate borrowing and spending.
So it's a delicate balancing act, trying to keep the economy humming along without letting inflation spiral out of control. It makes you realize that there are a lot of moving parts behind these economic forces we often hear about in the news.
And this deep dive has focused primarily on India, based on ClearTax article. But it sparks a broader question. What other factors, both domestic and global, might be influencing these economic forces?
That's a great point. It's like we've opened this Pandora's box of economic intrigue.
Yeah.
Are there other global players, events, or trends that impact what we're seeing in India, even on a local level?
Absolutely. The global economy is intricately interconnected. Everything from international trade agreements and geopolitical events to supply chain dynamics and even climate change can influence inflation and deflation across borders.
It really highlights how important it is to stay informed and view these issues through both a local and global lens. So to our listener out there, we encourage you to keep exploring, keep questioning, and keep connecting the dots. Look into the current inflation rate in your own country. Reflect on how those global events we talked about might be playing out in your community or even your own household budget. Because understanding these forces isn't just about acing an economics quiz. It's about navigating the complexities of our world and making informed choices for ourselves and our futures. And on that note, we'll wrap up this deep dive into the world of inflation and deflation. Hopefully, you're walking away with a clearer understanding of these economic forces and how they can impact your financial well-being. Until next time, keep those brains buzzing, and we'll catch you on the flip side of this wild economic roller coaster we call life.